It's time now to welcome our market master for the day. Nilesh Shah, Managing Director and CEO of Axis Capital, joins us now. Good morning, Nilesh. Quite a while since we had you on the channel. Thank you very much for joining us. There has been a bit of a correction in global markets. Indian markets seem to correct a little fiercely yesterday, but today, it seems to be unyielding. What is your sense? Are we getting a correction at all over here, or is that all what we got yesterday?
I think a lot will depend upon how the supply emerges. Compared to the peak of the market, the supply pressure is very, very limited. And we see the divestment, now bringing the supply into the market, which will help market consolidate around current levels. So it's the lack of supply which has probably kept prices at an elevated level, though fundamentally also it is getting supported.
Okay. What about the divestment itself? Do you think it will be swallowed well? Coal India as well as ONGC in particular?
See, definitely divestment, if conducted well, has the ability to attract new set of investors. There are many investors today who want to build meaningful position in India, but because the lack of depth in the market, in order to build a meaningful position in certain counters, they are unable to pick it up in the secondary market. Divestment provides that primary market supply for investors to build large positions, and if divestment is conducted well in companies like ONGC and Coal India, certainly it should be in a position to attract new investors to our market.
But traditionally, does this phase, a bunch of divestments coming and probably even PSU banks looking to raise some capital, could all this keep the markets a little depressed at all?
So again, it's a trade-off between short-term versus long-term. If our companies, our entrepreneurs don't get equity capital, the long-term growth will get impacted. We have been consistently saying that today India Inc. is paying more in dividend and receiving less in new equity raise. That's how the growth will get impacted for lack of availability of equity capital. So if the supply begins from the divestments, from the new entrepreneurs, from the IPOs, then certainly availability of equity capital will ensure that the future growth can be sustained, and markets will be cognizant of that fact. While in the short term it might give a correction, it will be definitely beneficial for the long term.
Nilesh, hi, good morning. So what should the asset allocation strategy be for 2015? Because of the fall that we are seeing in bond yields, do you think investment into long-term debt products, at least in the first half of the year, will yield better returns than investment in equities?
See, to a great extent, we had this golden period where you could have been long equity as well as long fixed income. Rarely equity and fixed income go hand in hand like this. But now the 10-year yield has already moved by more than 100 basis points over last 1 year and more than 50 basis points in last 3 months. So my feeling is that if you are entering at this level in long-dated gilt funds, certainly they will give positive return, but they are unlikely to outperform the equity market. In the equity market, if you take a longer-term horizon, certainly it has the ability to outperform fixed income. So while we are bullish fixed income as well as equity, we certainly believe that you should be more overweight equity, especially in large cap stocks, rather than fixed income.
Did you say how much of a fall in yields you are expecting, say over a 12-month period?
Lata, a lot of it has already been priced in. We have moved from above 9% to below 8%. That's a significant move without any change in the policy rates. If we see the shape of the yield curve, today 10-year yield is trading below 1-year treasury bill, 1-year T-bill is trading below 1-month treasury bill, and 1-month treasury bill is trading below the overnight money market rates. So certainly we have a very, very inverted yield curve, which is kind of factoring in that going forward there will be cut in policy rates and there will be some positive impact of that into the secondary market yields. But when you have moved from above 9 to below 8, that does factor in a lot of this movement.
Okay. Actually, we are getting a question from our money control message board. Our viewers can ask you questions. There is a gentleman, Ashok Kumar Bajpai, who is writing to us from Hardoi district in Uttar Pradesh. He says he has investments in SBI and Allahabad Bank, and he wants to know what is your outlook for these banking stocks. Even if you don't say for these banking stocks, can you speak about the banking stocks?
So I won't be able to comment on the stock side, but if you see the banking and financial services sector, the private sector banks have outperformed public sector banks by hands over mouth over last 15-20 years. If you were invested in private sector banks vis-a-vis PSU banks over last 1, 5, 10, 15, 20 years, your portfolio would have appreciated far more. So do look at what has happened in the past, and hopefully that will get repeated in the future. So in your portfolio, you should have private sector banks as well as public sector banks. Second thing, in the going forward phase, if you see, the banking and financial services sector will have to grow at a much faster level in order to support growth. If your credit growth is at 12-13%, your economy cannot hope to grow at 8%. Now, as economic growth will start recovering, it will get aided by faster credit growth, which should be beneficial to the profitability and valuation of the banking sector. So one should remain overweight banking sector, but do give representation to private sector banks as well as public sector banks in your portfolio.
Okay. I just wanted to come back to that point you were making about the fact that you are still bullish on fixed income products in the first part of 2015. So what should the strategy be over there? Is it better to invest into some of the tax-free bonds, or do you think it should be a simple, debt mutual fund investment that investors should look at?
So in the tax-free bonds, it makes sense only if you are in 30% tax bracket. If you are in 10 and 20% tax bracket, then probably investing in tax-free bond at this yield doesn't make that much sense. So for people who are in 10 and 20% tax bracket, they should try to buy long-dated, long-duration bond funds or government securities fund. If you are in 30% tax bracket, then certainly tax-free bonds even today make sense. And if you are not tax paying, then probably bank deposits of the longest duration will give you a far better return.
Okay. Well, Nilesh, as a personal finance advisor, what is the call at this point in time? Would the house call be to ask investors to concentrate a lot more on equities? Are you getting a sense that we are sitting on something big over the next 3 to 5 years?
Undoubtedly, if you see the longer-term prospects of the country, it appears fairly balanced vis-a-vis its peer group. In Russia, you have Ukraine crisis. The whole market cap of Russia today is less than the most valued company on earth, which is Apple. In Brazil, you have weak macroeconomic fundamentals. In China, you have almost Japan kind of situation developing where credit growth is being accelerated to support GDP growth. Over there, India looks finely balanced with inflation coming down, interest rates expected to come down. Current account deficit, notwithstanding yesterday's number, is reasonably balanced. Fiscal deficit is under control, and hopefully GDP growth should start recovering. So vis-a-vis all other peer groups, India appears to be finely balanced. We do expect earnings growth to accelerate in FY16 and FY17 vis-a-vis FY14 and FY15. So not only you have good macros, but you also have accelerating earnings growth in 2 years to come. And hopefully all these things will get reflected into the valuation and eventually into the market performance. If we see from the technical point of view, you have FIIs who are willing to buy India, and they have put their confidence by pumping in more than $16.5 billion year to date. You have local investors who are now putting money into the market. The SIP collection of mutual funds alone will be more than 25,000 crore a year. So you have demand coming in from local as well as global investors. And more importantly, market has polarized towards quality issuances. So supply is only coming from quality companies at reasonable valuations. It's not yet a mad rush where you can sell anything you want to sell. So put all these things together, you have good top-down story, you have good bottom-up story, and there is good demand for stocks. All these things will keep markets supported over 3 to 5 years undoubtedly.
In the first 10 days of December, we've seen some good outperformance from the entire FMCG family, so ITC, HUL, etc. However, these are not the stocks that have performed, through the course of the year. Would you put more money into the FMCG space, either frontliners or mid-cap names?
So essentially now the market has reached a level where it's the individual stock rotation rather than sectors which is going to play out. Within FMCG, if you see over last 10 days performance, it's more news driven related to a company rather than sector per se. So our approach will be to now go far more bottom up than top down. And yes, there will be stock rotation required to generate alpha in the days to come, as market had made a big move from 18,000 to 28,000. Going forward, it will be far more stock specific play, and you'll have to rotate your stocks to generate alpha.
What would be, I mean, I know you can't talk stocks, but which are the mid-cap areas that people should look at? Should one look at, it's getting into pipes and PVC is very famous now, either because crude derivatives are lower or because people expect infrastructure to catch up, or both. What can you give some broad guidelines in terms of the sectors that mid-cap hunters should look at?
So one caution which I would like to add is that today mid-caps are trading almost at the same valuation as large cap. Historically, we have seen that when mid-caps have started trading at same valuation as large cap, that's a recipe for correction. So today we are at the same stage. Second, unless until those mid-cap companies can deliver accelerated earnings growth, which could either come from deleveraging, whereby they have raised equity capital to repay debt, or the business prospects have improved in such a manner that they will be able to deliver double-digit earnings growth. Unless until this condition is met, one should be cautious in mid-caps at this level. You have far better opportunity in large cap. Obviously, there will be set of mid-caps which will outperform even large caps. But mid-caps as a basket, one will have to be cautious. Focus on a bottom-up basis only on those mid-cap stocks where earnings growth is likely to accelerate.
Right. Nilesh, as always, it was a pleasure speaking with you. Thank you very much for all your discerning views on the market.
Thank you.